Joining us to discuss is Paul Abrahimzadeh. He is 1789 Capital Partner, which has invested in SpaceX. Paul, it's great to see you on set.
Great to have me back. Thank you.
So come into this conversation. We've been sort of doing the thought exercise of what this would look like. And I mean, to the point of Saudi Aramco, that's not quite an apples to apples situation. If we did see these mega companies come through, a SpaceX and OpenAI, how does that get digested in the IPO market?
Incredible depth of liquidity in the U.S. capital markets. So whether you think back to Aramco or Alibaba, two IPOs I was fortunate to work on, the Petrobras historic $70 billion capital raise back 15 years ago, you've got the ability to place considerable capital in the U.S. and abroad. When you're talking about SpaceX or OpenAI or Anthropic, these are going to be deca-billion-dollar IPOs, cent-a-billion-dollar market cap companies, maybe $1 trillion plus. And these are must-own N-of-one companies with very strong global demand, very strong brand recognition, and incredible retail following when they're public companies. So we have no concern about market depth. I think it'll be a factor of structuring, timing, valuation that's really key.
Well, you call SpaceX a must-own company. It's a company that you own, of course. But talk us through, what that means. The idea that, when this goes public, if you're an institutional investor, it sounds like you just have to participate.
If you think about it, SpaceX or OpenAI or Anthropic will be in the S&P 500 12-month post going public. So it's part of your benchmark. You need to own it. It's a question of when you buy it. And there will be a lot of gamesmanship around the IPOs, and some people have pre-IPO exposure, given there's been material capital raising in the private market by all three of those companies. But again, these are must-own companies institutionally and retail, and they're going to move markets. So you're talking with SpaceX, a company that'll hurdle into the Mag 7 almost immediately once it's public. So we're incredibly excited. We think this is the year of companies going public. There's an incredible backlog. And we also think away from those companies, there's M&A activity emanating out of Silicon Valley that's going to be a real second catalyst to capital formation.
Just one more point, though, on the IPO thing and digesting IPOs of this size, because it's not just SpaceX. It's potentially we can get at least maybe 3 of those centicorns probably coming public. Do you need to space that out? Meaning, if one came and then another came a month later, would basically the first one dilute the second?
It's a great point. The reality is, the cadence is going to be very important, and you can't bring all of that paper to market at once. I think the fact of the matter is the market's been starved of IPO activities, you guys know, for the past 3 to 4 years. And there's a lot of excitement. So for appropriately priced must-own large cap equities, I think there's going to be exceptional demand. To put that in perspective, you look at a company like Alibaba, when they went public, that was a 20 plus times oversubscribed $25 billion IPO. So again, getting back to that point, there's incredible depth of liquidity in the market to support these jumbo deals, but you're absolutely right. The cadence will be very important.
With regards to the M&A activity in the private space, is that going to be more a function of kind of, smaller or say mid-sized companies pairing up, or are we talking about big giants buying competitors or maybe just or up-and-comers, I should say?
I think the latter. I think when you look at the equity value of a lot of the fast-growing, pivoting to free cash flow unicorns in the private market, they're incredibly additive to some of these larger cap technology companies that are looking for the next leg of growth. Many of those large caps have had a great 2024 and 2025 organically, and I think inorganic growth is going to be a catalyst that propels them to continued new revenue scale in 2026 and 27. So, we think looking at the private market, you've had relatively quiet M&A. There have been 3 or 4 notable deals across the unicorn landscape. I think there's a lot more of that to come next year.
Interesting. Do you think that comes in any specific sector? Is there any specific industry that you have your eye on that seems ripe for consolidation?
Across the sectors where we invest, I think they are all fair game. I say that because, whether you look at the large language models, you've got some of them where I think acqui-hires are a possibility, where you've got a fantastic business, but again, even if it's a deca-billion-dollar price tag, it's still a drop in the bucket for some of these mega cap technology companies. Semi-compute's another area. Defense tech, when you think about the disruption of the traditional primes, while the price tags aren't cheap on a multiple basis, on an absolute enterprise value, some of these companies are relatively small versus the incumbents. So I think you're going to get back to this paradigm we saw a decade ago of the disrupted acquiring the disruptors. And so beyond the IPO market reopening, we think that's a very important second catalyst on the come over the next 12 months.
Well, let's talk about some of the sectors that you do invest in. I'm taking a look at your portfolio companies. I see a lot of AI names, a lot of software names. You have some defense names in there as well. When you think about, what you hold right now, and you think about the different names in here, I see Databricks, for example. We spoke to the CEO a few days ago. Is the hope that, some of these companies in your portfolio right now do come to the public markets?
Absolutely. I mean, we look at our portfolio and roughly a third to 50% we think can be public in the next 12 to 24 months, credibly, based on their revenue scale, their path to profitability, their internal preparations. From our perspective, we're being very careful on the capital deployment. I think this is an incredible period of disruption. So when you look at the AI landscape broadly defined, we've got exposure that we're very proud of in companies like Crusoe from a digital infrastructure perspective. That industry's had a lot of focus in the last few weeks as you've seen CDS spreads widen in some of the large cap tech companies based on CapEx required to fund that build out, as well as large language models like Reflection AI that we co-led with both NVIDIA, DST, and others, which is endeavoring to be the leading open weight model in America to counterbalance DeepSeek and Qwen, where U.S. regulated industries need to build on an American open weight frontier model. There are other companies across AI like Cerebras and Grok, G-R-O-Q, that are going to be critically important as you think about challengers from a semi-compute hardware perspective. So we're making very calculated bets on behalf of our limited partners across that landscape, but always looking at disruption risk and a path to liquidity.
We had showed a graphic earlier about the percentage of companies in your portfolio that are AI native or at least AI enabled or something. I forgot the exact phrasing. But give me a sense as to how you sort of separate the wheat from the chaff, because I'm sure you know this. I mean, there are a lot of companies pitching themselves as being AI companies that really aren't.
Absolutely. Yeah. I mean, we have pillars in our portfolio like an XAI, which I think we may have talked about before, but you look at what Elon's done just in the past 6 months and the discussions around macro hard as a launch and a new disruptor for traditional software, X Money being an augmented new capability on X such that you have a real credible super app, which you have not really had to date in the United States. You've seen them in Asia, you've seen them in Latin America, but a real super app in America, which Elon is building. We're super excited about that. As you then look at the software landscape, which right now we think is at a very pivotal point. If you look at hedge fund positioning in semiconductors, it's at the 99th percentile, very crowded, because again, it's a direct levered play towards AI consumption and AI compute. You then look at software, 5th percentile. So people are pivoting towards semis away from software because software could very much be disrupted by this new wave of AI. So where we're investing in software is leading companies that are built on AI, that are relatively new, that we think will withstand this period of disruption. So Deal, for example, in HR software and payroll, Ramp in Office of the CFO software and expense management. We think those are companies that are built along with Databricks and Plaid and others to withstand this period of disruption. All right, Paul, great insights. Great to catch up with you. Paul Abrahimzadeh, over at 1789 Capital.